Good morning, all of you. Today we are going to discuss about a very important topic, as I said earlier, that is an importance of asset allocation. Now, before getting into details about importance of asset allocation, I just jotted down a couple of assets that normally people invest in. Those assets are, as I mentioned, which is domestic equity, international equity, gold, commodity, bond, fixed income, where you have fixed deposits and corporate deposits. Then you have life insurance, mutual fund, cash, business projects, and currency. So these are basically the assets where normally people invest in. What exactly I have experienced in the last 3-4 months in the last COVID situation is that a lot of pressure has gone into redeeming one investments in the equity front, in the domestic equity front. Now, when I see there is a redemption pressure in the domestic equity front, when the market is 40-50% down, you have all seen that in the month of March end and April beginning, the market Sensex has dropped from 42,000 to 25-26,000 level. It is much lesser, although it has increased to 36,000 level, but still it is down than what it used to be in the month of December, January. But the most important factor is that the people have withdrawn a lot of money from equity mutual funds, and they have stopped their SIP during this time. Stopping SIP is what exactly I can understand, because there has been a problem going on in the job front. There are problem going on in cash flow, which I understand. But then there is a clear indication that the person's asset allocation is not in sync with what is it's supposed to be. Equity is at 40% low level right now. In fact, if you have invested in 2018, you are at loss right now. So in 2 to 3 years times, there is no return from equity investments. And if you are redeeming right now, you are redeeming at a loss. Now the question here is why you are redeeming. Yes, there is a requirement of your cash. Now, if there is a requirement of your cash, then why the money is not being parked in a liquid assets? Why the money is not being parked in a cash or a liquid funds or a government bonds, which are of zero risk kind of asset class? The questions comes because that's why I'm discussing about asset allocation today. Suppose, say for example, if I have 100 rupees in my kitty, and if you are going to invest in something, what normally happen is that you go and approach a banker, or some financial advisor approaches you, and they show you some products. Okay, product may be a life insurance product giving a guaranteed assurance return, or a mutual fund which is giving some kind of return. They normally show the past performances and exactly, and or probably some realtor who are showing in some property as giving lucrative properties coming up. Their property price will go up in X number of days, or gold investment showing that how much return those have been given. And normally you fall into any of this asset class and you buy. Now the problem here is, if you have 100 rupees in your kitty, and you are investing the entire kitty into those asset class which are been told to you without doing a proper asset allocation, the chances are that you are going to suffer, you are going to make losses. Because in none of the asset class I'm going to show you, they will not be consistent with your expectation of return. So, to share with you an analysis of the same, I can give you a data. If you see the data here, I have drawn an analysis of debts, which is a fixed instrument, equity, which is a domestic equity, gold, you all know, and international equity. Now, this is the best performance, this is the worst performances, and we have included the year 2007 to 2020. Now, in 2007, equity has given 56% return in 1 year. Whereas in 2008, we all know what exactly happened in subprime. Equity has given in minus 51%. And then you can see the different frame of return of the domestic equity has given vis-a-vis the international equity also, and gold and debt also. Debt means fixed instrument, which has given in 2007 7%, 2008 9%, 3%, 5%. It has given a consistent kind of return, but in that range. Whereas in domestic equity, you have seen the kind of fluctuation it has happened. So if I have 100 rupees in my kitty and I invest in 2008 beginning, seeing the result of 56% return past performances, so what is going to happen is that the entire money will go down by minus 51% in that year. And if I required funds, suppose for any instances, because I park the entire money into the equity fund without knowing the asset allocation, and my expectation is this kind of return or any return which is a higher than fixed income, I will get a very negative experiences. So asset allocation comes to your mind. It depends upon individual to individual. It depends upon individual risk appetite. Now, when I talk about the risk appetite, it is important to understand one should have adequate liquidity in their hand before they look for other investment avenue. When I say the adequate liquidity, what is the adequate liquidity? What is the definition of adequate liquidity? Normally, the definition of adequate liquidity is that one should have 6 months. One should have 6 months expenses in a liquid assets. Liquid assets mean cash or liquid fund, wherever you want to keep. So if your monthly expenses is 2 lakh rupees, you should have 12 lakh rupees of liquid assets in either in cash or in liquid funds. Okay. Plus, if I presume that everyone has a mediclaim insurances, plus you should have an adequate mediclaim insurances liquidity cover also. So that after these two things, now you go into the investment category. So investment category, what happened that you have to understand, take into consideration if you are investing in equity, be it in domestic equity, be it in international equity, the duration of an equity investment should not be less than 5 years. So if any one of you are investing in an equity with a duration of less than 5 years, the chances are that you are going to suffer. As you see in the international equity also, in 2007 it's given minus 6%, 2008 is minus 22%. And if you see international equity this year, if you see international equity in 2009, it is in 22%. This year, it is that data is about 2-3 months back. It is June now. It has gone up much significantly because of other factors which has played into. Because you know what happening in a US economy and all these things, the market is booming because of Fed keeping too much of pressure into too much of money into liquidity. I told this in a last week webinar. So irrespective of that, so if you are investing in equity, it has to be less than 5 years. In less than 5 years, also you can do a switch between different asset class in the equity once you book the profit. So that's a equity segment. So you do not pull out the money, you just park the equity money, and if you make a profit, you move into the debts and other category. But if you are investing in equity, do not expect that money to get back to you before 5 years. So if you are doing that, probably you will end up making losses. And then and gold investment, okay. And then you see the gold investment. Every individual investor's portfolio should have 10 to 15% of gold as an asset class. You know, gold as an asset class is such an asset class that irrespective of whatever happened in the economy, if the economy is going through a worst kind of situation, we know the what happening in the COVID kind of situation right now. All the businesses are shut down, and all the economy, world economy, central bank has pumped in a huge amount of money. If the economy do not revive in next 6 months or 1 year time frame, you will see gold going up from here. So gold is a huge asset class in the sense you hedge against all risk parameters which are available in equity, debts, any other asset class. So gold, everyone should have a 10 to 15% of gold. As I told about equity, it entirely depending upon your risk parameters. Once you have the liquidity in your portfolio, then probably look for a gold, and then you probably look for an equity investments. And now in equity, there are different categories. I'm not going to discuss about those categories: small cap, large cap, mid cap, and multiple other categories, thematic, pharma, and all those kind of things. So that entirely depend upon the kind of risk that you want to take. But equity investments should be for the minimum 5 years, and then you go to the insurance. Insurance, like one is to cover their own life, and then look for an insurance as an asset class. Now there are a couple of insurance policies which give you a guaranteed kind of return, and there are a couple of insurance policies which give you a market link kind of return. So if you are going for a guaranteed kind of return, look for the yields that they are giving, look for the IRR that they are giving, and not for the exact return that which has been shown in the prospectus. Okay. And then you look for an property as an investment. Now, what happened that I have seen a lot of people that they are too much of biases towards one asset class. Okay, so they have their cash, but what exactly happened is that they invest too much into one asset class. Like someone is too much biased into property, and we have seen what property return has given for the last 4 to 5 years in India. And with going ahead with the kind of world economy and kind of thing, I'm not seeing a huge increment in property price going ahead. You will see the commercial investment, commercial property investment, which was very lucrative 6 7 months back. Also today, I don't think so. It will going to rise in the near future, because a lot of companies today, if you talk about TCS for example, they have already said that 75% of their employee will be working from in the next 2 to 3 years. And that means you can understand the kind of demand that will go for the commercial properties. So if I am investing too much into one asset class, be it equity, be it property, be it insurance, be it gold, I run the risk of timing. Okay, and probably irrespective of the return expectation I have, I will end up making losses. The reason is that one never know that when there will be a cash requirement from one side. So the ideal way of asset allocation is you need to park your money into a cash, which is 6 months of your expenses. Plus, you need to park adequate amount of mediclaim. You do have a mediclaim, but you need to park adequate amount of health funds. And after that, you do an asset allocation and not into one asset class. That's why I always say that don't put all your eggs in one basket. You put an equity, debts, gold, and property. Now, how much percentage you put all those things into depend upon your risk parameters. Okay, that's also so. If you already have one or two properties, and the property investment is basically of an investment and not for your own residential purpose, you need to think about why are you going ahead one property and into all. Why don't you buy an equity? Why don't you buy a gold? Why don't you buy a debts into your portfolio? I'm going to show you the kind of return uh, this different asset class has given over the last 10 years. You see, in the last 1 year, equity has given minus 25% return, whereas the debt has given 10% return. Now, debt, when I talk about the debts, it including government bonds, it including copper deposit, including bank fixed deposits, commercial paper, and all inclusive. You know, in a debt doesn't include the bank FD alone. In debt category, there are a lot of other asset class also where you can leverage. In the last 1 year, debt has been, apart from gold, debt has been one of the most important asset class. And those who have invested in debts in the government bonds and all, they have get huge return. This 10% is the average return. There are a lot of people have gone 15-16% return because government bonds has given a massive return. We have seen the rate cuts happening, and whenever the rate cuts happening, the debts give a higher yields. So I presume that this is going to happen if you if you keep investing in a government bonds. Government bonds right now is rating at 5.84%, 10-year GSE yields. I'm presuming that the rates will come near about 5.2 to 5.3, and when the rate is going to cut, probably I don't know, it will take 6 months, 7 months time. This yields will go up. Okay, gold, as I told you earlier, also it has given phenomenal return. If the economy does not improve, it's going to increase. See, in 2019 also, we have gold has given a very meager return. So what I mean to say in this data is that every year you will have a different asset class which is outperformed. Now, if I keep property out here, you know the kind of property return which is given in the last 4 to 5 years is from the time of demonetization and GST in India. You have seen the kind of property return coming up in India. So investing in one asset class or having a biasness towards one asset class will lead you towards not having utilizing the tremendous potential all asset class has. So that's what is about. I'm going to share with a couple of more data. I showed you this thing. So here, the current dilemma right now here is where should I invest right now? Okay, the fixed income return is too low. Fixed income, when we talk about, we only think about fixed deposit. The return is not low if you look at the government bonds. Government bonds are still giving a better yields. It will giving double digit, probably 8, 9, 10% return also, depending upon the duration. By equity, you have a dilemma. Then you have a real estate. You have seen the kind of inflation and kind of cycle, or if you keep hoping that the return will come back to me. But I told you about the commercial real estate price and the personal real estate price and the kind of economy, and we are going through. It is all linked to each other. I don't see it is going to a massive hike from here. What we used to see in 2008, 9, 10, or 5-6 years back, it is not going to come back. Gold, I've already told you, so that's the kind of thing. And if I see again the data, I just scroll. Okay, if you see the data out here, I show equity, debts, international equity, and golds. If you can see in the kind of return that each and every asset class has given, so none of the asset class is like consistent, and none of the asset class is 1 year it is in supreme, and the another year it is goes down. So you cannot solely depend on one asset class and another. Here, the important analysis that you need to do while doing an asset allocation is the correlation between one asset class to other asset class. When I talk about the correlation, so I talk about the correlation between equity and a debts. I talk about the correlation between property and a gold. So if a two asset class having a similar correlation, okay, if the two asset class have a similar correlation, so do you really does it make a sense to invest in that particular asset class in a one go? It doesn't make, because you will end up getting a very less return, because as I showed you earlier also, as I showed you now also, one asset class this year maybe giving a huge return, but probably in the next subsequent year it will not be. So if you're buying a two asset class which are correlated to each other, probably 1 year you will get a good return and next year it will not be. And it is absolutely difficult to keep switching between one asset class to another asset class every year and then. So I show you how the correlation of different. So this is the different correlation. I have taken the index out here. Nifty 50, you all know, which is the Indian equity. I have taken CRISIL Composite bond, which is a debt market bonds index. S&P 500, which is the international index, and this is a gold. So this is a different asset class index I've taken. This is the different asset class index. So if you see the Nifty with Nifty, it is 100% correlated, right? If you see the correlation between Nifty and the bond market, it is only 12%. So it is only 13% approximately. So 13% means, so if you're investing 100 rupees in Nifty and 100 rupees in bond, the correlation is only 13%. So that's the kind of thing. If you see the international, this thing, it is only 20% international equity, and gold it is 0.19%. So we can understand that a correlation between a domestic equity and a gold is 0.19%. So if you have 100 rupees in your kitty, after keeping aside the liquid funds, after keeping aside your liquidity requirement, if you have funds, right, so you should invest as per your risk parameter in gold as well as in domestic equity. Because what is going to happen is that in case of emergency like kind of situations, if you need to withdraw money which is over and above your liquid asset that you have kept, these two are completely different in correlation. So you can always plug in money from other, because it's not related to this thing. So if I see the CRISIL, the composite deposit also, so here we check again, the gold is a different correlation. International equity is also different correlation. So if you're investing in fixed deposits or government bonds and other kind of asset class, 100 rupees. So if you have 100 rupees, so you should look into some portion of investment into international bonds also, international equity also. So if I again this kind of correlation, so we have given you the correlation between one. So my idea is that one should always know the correlation between one asset class and other asset class, and then go for the investments. If it is not, so suppose, say for example, if I invest the entire money in bond market and foreign equity, then these two correlation, if you see, this CRISIL and see, this two correlation is 100. This two correlation is composite index, and okay, this two correlation is again -1, but this is absolutely good correlation. But if I see that there is a correlation, there is a very equal correlation. So I give you an example here. So if you've invested entire money in, suppose, say, international equity, and if you're invested enter money in one asset class, and if something emergency comes up and you will require money in that circumstances, and that in a particular year that asset class goes down, so what is going to happen is that you have to withdraw money in loss. So exactly what happening in the last 4 to 5 months, I have seen a lot of investors, they are withdrawing money from the equity just because, okay, it may be a need for them, just because that they have withdrawing the money because they have not invested in different correlated asset class or some asset class which just struck. If somebody is invested too much into property where money is not liquidated easily, so you got stuck again. So if you have 100 rupees and I have invested 50 rupees in equity and 50 rupees in a property, well, equity and property, it's not fully correlated, but one thing is important, that property is not a liquid asset class. So what exactly happened is that you will pull out money from the equity, and probably you have invested a couple of money in an insurance policy which is a 20 years lock-in period. So again, that is not liquid fund. So you have to understand, when you go for an asset allocation, you need to sit with your professional advisor. If you sit with your financial advisor and discuss about the kind of cash flow that you're requiring, kind of asset allocation you require, he will always guide you about understanding your risk appetite and thing. So instead of buying one single product, if somebody is coming up with a 7% fixed deposit, or a guaranteed insurance policy of X amount, or any kind of thing which is only one single product, I don't think so it will do justice to you. You have to understand the entire asset allocation correlation. You have to understand when you might be requiring a cash flow which is out of the box. So how can you withdraw money? How can you get the money from those kind of things? So those are the things. That's why I say asset allocation is so important. Again, this return I've already sold multiple times. Last 1 year, Nifty has given minus 30%, minus 12%. In fact, in the last 3 years, Nifty has given only 3% annual return. So which is nothing. You will say, if I park money in savings account, I will get 4% return. If I park money in bank FD also, I will get 5.5% return in last 3 years. Even in last 5 years, a Nifty has given 5.5%, which is less than a bank FD also. Then you think, what I am doing? But if you see the return in the last 10 years or 15 years is much higher. Understand that 10-year return of 8% and 10-year return of even 7% is huge difference. Because 2% in a compounding atmosphere comes up to be a huge number. If you see, is the bond market in the last 1 year has given 13% return. This is the composite index return I'm talking about. So as I said, it is double-digit in common bonds has given a huge return. You see the kind of return that is given in the bond market, fixed deposits. Okay, and then you see the international market return. It has been phenomenal for the last couple of years. And then you see the gold return, kind of the 30% return 1 year, and then you have the 7%, 8% return. This data is from the Bloomberg data. So that's why I'm saying that why asset allocation is important. You need to understand the correlation between different asset class, and then you go for investments. That's what for me from here. And I can only say that if you are looking to invest, don't go for one particular asset class. Sit with your financial advisor and understand what asset class is correlated to what. What asset class is a liquid freeze amount. Disclose all details to your financial advisors. Have a professional discussion with him or her, whosoever you are connected to. So that's my purpose of today's webinar, is to make you clear about why asset allocation is important, why you should not be going to buy one product just by seeing his past performance or past returns. It do not sustain. I have shown you that each individual asset class give return differently in different year. So it doesn't matter ki today I buy equity, international equity, because last 3-4 years it has given 20-22% return annualized. Whether it will going to sustain, we never know. Nothing is for sure. But what is more important is that if you understand the dynamics between different asset class, the correlation between different asset class, you're not going to suffer. Okay, you're not going to make some losses. I am clearly seeing the trend that whenever someone is pulling out money from the equity right now, I am a clear opinion that there is a huge gap in the asset allocation matrix that the person is following. That should not be. You should have enough liquidity in your asset, in your hand, to counter any cash flow or any emergency problem. Apart from that, you choose an asset class which is perfectly fits in your kind of expectation and your kind of financial planning that you might be having. If you are expecting a return of 20-25% just because some asset class has given past, it is not going to happen, because any asset class which is giving you return this year 20-25% may not sustain in next year. Some other asset class will come up. You see, gold 2-3 years back has not given any return, and this year it has given more than 30% return. Whether it will sustain in next year, we don't know. If the economy thrives, it will not. If the economy go to a similar situation what we are going right now, it is going to move high from here. property we have seen for the last 4 or 5 years are not given return. So will it give return in next 2 to 3 years? No one can say it with surety. But that's what I say, that if you have 100 rupees in your disposal, park money in such a way that you take advantage of each and every asset class movements. Okay, keeping aside the downside and keeping aside your liquidity or any cash flow requirement in between. So if you have any questions, you can ask me in the Q&A below. That's where I stop my sessions today. Thank you for listening. Thanks.